Hi everyone, welcome along. Come on and make yourself comfortable. Jason and I are sitting comfortably here, so we'll just give a minute for everyone to join and then we'll kick off our webinar. So we'll just give everybody another 30 seconds or so to get settled, and then we'll make a start. All right, we're going to make a start. So welcome to our webinar on investing in 2021. I'm Jeff Thurecht. I'm the Director of Australian Advice Network and Evalesco. And I'm really looking forward to taking you through our special Q&A session with Jason Orthman from Hyperion, who you can see on the screen there, and I'll introduce Jason shortly. Jason and I are sitting comfortably in our offices in separate cities, Jason up in Brisbane, me down here in Sydney. And while you can see and hear Jason and I on the screen, we can't see or hear you. We've got you on mute and your video is turned off for the duration of the webinar. We do encourage you to ask questions as we go along though. So you can do that by clicking on the Q&A tab, which you'll see down the bottom of your screen, and typing in any questions you might have there. So I'll check on that as we go through and try to fit those questions into our conversation. I'll get to them at the end of the conversation. So please do fire away with your questions. Also wanted to let you know that Jason's put some slides together as well, with a bit more detail and supporting some of the conversation we're having today, but we're not going to put those up on the screen because it gets a bit busy. So we thought it might be a little bit more engaging. We'll have a good chat about some of the important factors for investing in 2021. But fear not, for the visual learners, we'll post those slides up on the website and you'll have access to that via an email, which will come out after our session. So look out for those for more detail. So just before I launch into it, I need to give you the general advice disclaimer. So it's important to point out that even though most of you on the webinar are clients of AAN and Evalesco, the information provided in the next 40 minutes doesn't specifically consider each of your individual circumstances, so it isn't personal advice. If you think you should be acting on something that we discussed today, then please speak to your advisor first. So with the formalities out of the way, I'm really pleased to introduce Jason Orthman. So Jason's the lead portfolio manager and deputy chief investment officer at Hyperion Asset Management. A bit about Jason: he joined Hyperion in 2008 and was promoted to deputy chief investment officer in 2017. Jason's also an executive board member of Hyperion and continues to serve as the lead portfolio manager across its three equity strategies, which is Australian equities, small cap and global equities, and we're focusing on the Australian equities today. Jason has a Bachelor of Chemical Engineering and a Bachelor of Business Management from University of Queensland, amongst a host of other qualifications. So just letting you all know, Hyperion's Australian Share Fund was added to the AAN models in December, and we're very pleased to have them on board. And congratulations on the recent nominations for some Morningstar Awards as well, Jason, which is great recognition. So welcome along, Jason, and thank you very much for giving us your time today.
Thanks, Jeff. Happy to be here.
Good stuff. So I thought a good place to start would be by learning a little bit about Hyperion, the background, and a bit about the investment philosophy, if you wouldn't mind.
Yeah, sure. So, I mean, Hyperion's in our 25th year, actually. So we started in 1996, and it came out of a local stockbroking firm called Wilson's, and that's actually morphed into Pinnacle, which is listed on the ASX. But Hyperion's the original boutique of funds management business, and as I mentioned, that broking firm really wanted to set up that funds management business. So we were able to start with a clean sheet of paper, which meant what we were doing is really concentrated, benchmark unaware, and a sort of concentrated growth style. And so starting from afresh in sort of 1996 allowed us to do that. But What sort of attracted me to Hyperion as well. So I worked in that broader group of Wilsons as a research analyst since 2002, and as Jeff mentioned, came over in 2000 and 2008 into the funds management division. But what I noticed is there was really two camps in the market. There was traditional value investing, which, when I started in the industry in the early 2000s, was really quite dominant and an incumbent strategy. And then you had sort of these emerging growth investors. But what tended to happen is growth investors would do quite well for a while, and then they might take a hit to some of their stocks of the portfolio, and mean reversion would kick in. And so what interested me particularly about Hyperion is not only is Hyperion looking for sort of structural growth, but they've added a quality and valuation overlay. And so it comes back to protect and grow. So the first thing Hyperion wants to do is, before you earn the right to compound and grow at double-digit rates for a long period of time, you have to make sure there's low fundamental risk in those businesses. So what that really means is, when you're investing in these growth businesses, you're not backing concept stocks, you're not backing momentum stocks, you're actually backing those large, proven, profitable players, which is a big unique factor, I think. And then we added the valuation.
Just on that, what do you mean by concept and momentum stocks?
Yeah, so like, one of the inefficiencies that I think Hyperion exploits is that we can tell the difference between an exceptional business and an above average business. And that's actually pretty hard to do, because companies can have momentum, grow pretty well for a long period of time, and then that sort of fades out. And it's the exceptional businesses that can continue to persist and sustain growth levels at really high levels for year after year, decade after decade. And some of those things are like Cochlear, REA, or realestate.com.au, Domino's. They're all exceptional businesses. And so a lot of growth investors can't distinguish, or investors in general, between those exceptional businesses and above average businesses. And so they take that basket approach. And then if you take a step back, to your question, Jeff, what they end up investing is momentum or concept stocks. And so, yeah, the sales growth, earnings growth are pretty good now. There's a lot of excitement behind these businesses, but because of their value proposition or sustainable competitive advantage or the industry positioning might be that strong, they can't sustain that. And so that one day you wake up and those growth rates have evaporated, and then you have these big D rates, which happens, time and time again. And then on the concept stocks as well, the underlying economics mightn't be there. They might have a good concept, a good, business model on paper, but they haven't actually achieved that market leadership, that dominance market leadership. They're the obvious number one player, and they haven't shown that the underlying economics there. They mightn't be highly profitable. They're sort of promising that. And so in and around that sort of growth investing about, getting the exceptional businesses, the reverse of that is to avoid those sort of momentum and concept type stocks, I think.
Okay. And so you just were about to mention there's a value overlay as well.
Yeah, and that's right. And so going back to this value versus growth thing can be quite simplistic, because a lot of value investors are focused on short-term PEs or short-term EV to sales or short-term metrics to get a gauge of how expensive or cheap something is. But we believe if you actually want to compound at high rates, you need to act as a business analyst, and you need to actually have an estimate of a business's intrinsic value. And so we're very valuation centric, although it's not short-term PEs or short-term dividend yields like the market operates on. It's actually comparing it to the intrinsic value in 10 years' time. And so if you want to reverse engineer that, you should be focused on, pick a metric on PE. Well, what will that PE look like in 10 years' time if you can accurately forecast out those earnings over a long period of time? And if they're really good businesses, a strong value proposition, a strong competitive advantage. So you think they're still going to be the number one player in 10 years' time, and you can work out how big the industry and what share you think they can get. Well, the interesting thing is, what PE will that stock be on in 10 years' time? And if the earnings are growing at high rates, maybe it's only on a single digit PE if we achieve our earnings forecast in 10 years' time. But that's obviously, if they're still growing, the market's not going to price it on that low PE. We'll rate to those high short-term PEs. And that's the issue. Like, if you get these exceptional businesses, they do trade on optically high short-term metrics. So REA, for example, or realestate.com.au is traded on 45 times PE through the history of its listing. And so it always looks expensive, but we bought it at 80 cents and today it's traded well through $150. And that's been a 15-year story. And we've always said, well, actually have a look at what its PE will be on in 5 or 10 years time. If we're right and its earnings continue to grow at double-digit rates, it might only be on 5 times or 9 times PE.
Relative to that initial purchase price.
Yeah, that's correct. And as you get closer, the share price gets dragged up by the earnings. So we are long-term value, not short-term value. So we just do it in a bit of a differentiated way where we work out the intrinsic value in 10 years' time, compare it to the current share price, and we forecast out an internal rate of return for every stock. And if that internal rate of return is too low, then obviously, we won't purchase that stock. And even when we go into the portfolio, I don't want to get too granular, but the portfolio management, the higher the IRR, effectively, the higher the weight, or the lower the forecast internal rate of return, the lower the weight as well. So,
okay, great. Thanks for that background. So that's been a pretty consistent philosophy throughout since Hyperion was set up, and obviously served you very well. Performance has been fantastic. But if we look a bit more short term, looking back over the last 12 months, performance has also been really good. So congratulations on that. How was the portfolio positioned 12 months ago, and how would that differ today, given what we've been through? And we've all been through a lot in the last 12 months.
Yeah, no, it's a really good question, because you need to sort of provide context, because obviously we've had COVID in between that, and that's allowed us to reset our portfolios. So if you looked at the portfolios today and compared to them 2 years ago, they'd be quite different, which is unusual for Hyperion, because we do want to hold these businesses for 10 or 20 years. And obviously we move the weights up and down around those core holdings to increase our performance. So you can have periods where, you might only sell 1 or 2 stocks, purchase 1 or 2 stocks per annum. And you're, as I said, trading around those positions and getting the right weights, but it can look like there's not that much activity. But obviously COVID or that shock really allowed us to reset, add some new names, and really reposition the weights. And it's really allowed us to really feel like it's day one again. So if you look at Hyperion's track record and performance, getting some of those names early at their inflection points, like, again, Domino's, REA, the Cochlears, all those type of, the Seeks, the car sales, Hyperion was very early in identifying them as exceptional businesses and being undervalued on a long-term basis. And they've met the earnings, have compounded up at double-digit rates. But as you look now, as we've gone through COVID, the portfolio is being completely repositioned. So your larger weights of things like your Afterpays, your Zeros, your WiseTechs, your Fisher and Paykel. So effectively a next generation of stocks have started to drive that outperformance over the last year or two, and have become the larger weights. And that's why I say the portfolios look different. But again, if you take a step back before COVID, we were outperforming ahead of COVID and doing well. But the alpha was even greater. The outperformance was just augmented through COVID, because we positioned the portfolios at really high levels of structural growth, because we were really worried that there could be some downturn. And we thought businesses and consumers were pretty fragile. And we've had that view for the last 2 or 3 years. And there's a number of macro headwinds, which provide the context for that. And so we had a portfolio that was pretty resilient and not that sensitive to economic conditions. So when COVID hit and you had this containment crisis and the economy really contracted, our businesses were really well placed and allowed it.
What do you mean by that structural growth?
Yeah, so even when you look at growth investing, within there's a cyclical element and a structural element. So some companies might only be growing well because the conditions in their industry are favourable, and they might only be for a temporary reason. Maybe credit growth is really strong, so those related to financial services are growing strong, or maybe commodity prices are really strong, so it's supporting associated industries. But what we are not trying to time short-term catalysts or short-term growth catalysts. We're looking for this structural growth, which means it's enduring and can last for years, if not multi-decades. And the great thing about that, if it's structural or enduring, it means that you're not that sensitive to broader economic conditions and conditions in your industry, because there's a value proposition or a reason why these companies can take market share and grow in all conditions. And that's what we expect from Hyperion's portfolios and the Australian equities portfolio. We expect growth in all conditions because these are modern businesses, they're dominant businesses, they're disruptive businesses, and they have the ability to take market share. And your average business doesn't have that. They tend to just grow in line with the broader macro environment or their broader industry, and their sort of cyclical growth businesses, the structural ones, because of some fundamental shift that's happening in society, can grow for long periods of time, regardless of what's happening in the broader environment.
Okay, great. Thanks for explaining that for us. So you mentioned a few companies there, and you also mentioned the term modern businesses, and it seems that I guess the portfolio is a little bit weighted towards modern businesses, technology companies in some ways, like Afterpay and Xero, sort of newer style businesses, and also WiseTech that you mentioned as well. So how do you sort of reconcile that with, there's a lot of talk about tech stocks being overvalued or, too high PEs or that sort of thing. So how do you think about that? Do you have, really solid sell targets, or are you looking to hold them for the long term and understand that that's how that sort of plays out?
Yeah, it's a good point, because I think everyone gets caught up in a lot of noise and tries to generalize and simplify, and life and markets are more nuanced and complex than that. And even when you look at the US stock market over the last 90 years, 1% of the listed companies over those 90 years have driven all the returns. It's been really, really narrow. It's 4% of companies. And when you go out and look at the major developed markets outside the US, including Australia, it's even narrower at about 1%. So it's really important to get these companies that are actually going to lead the markets higher. If you're a long-term investor, to your point, Jeff, if you want to get compounding, if you want to hold these businesses for 10 to 20 years, you got to be right, and you got to get those small 1 to 4% of companies that are going to lead the markets higher, and they're always optically expensive. And so you do need a robust way of valuing these businesses, which is where our 10-year internal rate of return forecast comes in. And you do need that quality overlay, which is before we even try and build a financial model and value these businesses out 10 years and compare to the share price. We have this 125-page research template, which looks at the quality of the businesses, which is effectively, is this structural? Is this enduring? How can they take share in all conditions? Why is the value proposition strong that they're taking share from their competitors? They're growing through a GFC, a European debt crisis, a COVID. And why is that repeatable and sustainable? Like, what is the sustainable competitive advantage or the moat which is going to stop people taking share? So we do all that detailed work, so you can focus onto that 1 to 4%, that narrower subset, because you are right. Like, there's a whole bunch of companies that will fade out, that are overvalued, that the earnings will not turn up in 10 years' time, and therefore there's a whole lot of fundamental risk. So we're not so much focused on, again, what that short-term metric is, but what does it look like in 10 years' time, and what is the level of fundamental business risk? Because if the fundamental business risk is low, any share price falls will sort of be temporary, and you will recover as earnings compound higher. Of course, if it isn't sustainable, then as the share prices fall, they simply won't recover and they'll stay down. And that's what I was sort of hinting at earlier, why growth investing is so hard, because as share prices fall, when you get inevitable corrections or tougher periods, you need a mechanism for them to recover and grind higher. If they stay down, well, that's a permanent loss of capital.
So do you think, I guess coming back to, as you're saying, the easy high-level view is to look at tech stocks and volatility. Do you think, as a result, your portfolio being very long-term focused, but do we expect more short-term volatility?
Well, the counterintuitive thing about the Hyperion's portfolio is our best periods are really in a crisis point. And we saw that where we captured sort of 20% alpha through the GFC from fiscal year to 30th of June 2009, which is a long time ago now, and then also through the European debt crisis and through COVID-19, we're running at rolling 12 months alpha of nearly 30% or outperformance versus the benchmark. So our best outperformance periods, are in a crisis, and in normal periods, because our companies are growing stronger, we tend to get some positive jaws and outperform as well. When for us, our underperformance periods actually tend to be when you get these sort of cyclical rallies and conditions are improving, because your average companies tend to get bid up, or they go from a P of 9, call it, to a P of 12. And our companies retain their high short-term multiples because they're valuable companies, but they don't get that same uptick that your lower quality businesses get. So that should provide contents over a short period of time. But you are right, we're very differentiated to the benchmark. We own 25 equities in the Australian equities product, not the other 2,000. So you can get short-term periods where the portfolio performs differently to the market. But for us, as long as you get that earnings growth coming through, the portfolio tends to grind higher. And really it comes back to fundamentals. Like, we get results season like now in February and as into March when people digest it, in August when you get typically your full year results, and then people digest it in September. So you can get random walks and narratives, through the year. But as long as when our companies print their results and the sales growth rates look good, the earnings look good, the balance sheets are strong and the free cash flow is there, the markets will respond and react to that. So we're not that concerned about any short-term volatility or movements away, from what the benchmark is doing, because at the end of the day, if you're prepared to hold through these periods, the fundamentals will dictate where the share prices go, and the share prices will follow those earnings. And that's what we've seen over really those 25 years.
Fantastic. So you just mentioned the benchmark and a lot of the names you mentioned, obviously people will have heard of those companies, but they're certainly very different from the traditional sort of Aussie investor portfolio that we used to have of holding lots of the banks and BHP and maybe Wesfarmers and Woolies and the like. Do you deliberately stay away from those types of companies, or how does that come into your thinking?
Yeah, so we're looking bottom up for these companies that are going to lead the market higher. And so we want to find the next blue chips, not the established blue chips, which people can, understand. And so some of those names you mentioned, like, if you go back 10 years plus, we've owned Woolworths, for example, and some of the major banks as well, we've owned as well. But today we do not own those. Like, a lot of those known consumer brands, like, again, the Woolworths, the Wesfarmers, we don't own any of the major banks. We don't own the major resources. We don't own AMP or Telstra or anything like that, because investing is about looking forward, not looking backwards. And we're not interested in owning those sort of effectively old world, large maturing businesses. We want to find those businesses that can compound, again, those organic sales and earnings at high rates. So we look very different to the benchmark. And when we look at it, we think there's a lot of fundamental risk in the benchmarks and those businesses that people don't really understand. And maybe some of the learnings that people have had from AMP or even a Telstra, where the experiences probably haven't been that great, shows you just because they're large, consumer brands and big percentages of the index doesn't mean that they're going to produce a good outcome for you. And so I think people are starting to understand that more. But when we look at the ASX 300, which is effectively what we bench to in the Australian stock market, we believe by market cap, 77% of that index is old world. And what I mean by old world is businesses that are not growing and that have the potential to be disrupted. And we'd put the major banks in that. And so there's a lot of fundamental risk, we believe, in owning those businesses. And it goes back to that protect and grow. So we simply won't own those businesses.
Great. Any of the businesses that you own in the portfolio at the moment, would they be materially impacted through premiers closing borders or lockdowns or those sorts of things, which hopefully are behind us with the vaccine being rolled out and those types of things? But any of those that particularly exposed?
Yeah, so like on a few individual cases, but really Hyperion's portfolio, because of that low sensitivity to economic conditions and that belief we want each of the businesses to control their own destiny, means that our exposure to lockdowns is pretty low. Like some of the healthcare businesses that do own, of course, if you go down into a containment crisis or a lockdown of a hospital, for example, that will impact Cochlear's implant sales into those hospitals. ResMed as well, which is a dominant in sleep apnea, as clinics get shut down. CSL as well, it makes it harder to collect plasma and for people to donate. So there are pockets that get impacted, but by and large, a lot of our businesses outside the healthcare are those modern software as a service, technology driven businesses. And in fact, they get a boost from COVID, because people realize you can't have this on-premise legacy software anymore. You actually do need a modern way to operate. You do need digital delivery. You need good functionality, and you need good software. And that's obviously what WiseTech provides in logistics. Good software for that. It's what Xero provides in bookkeeping for small businesses. And it goes back to your earlier question earlier, Jeff, about structural growth. I neglected to mention that we have this world view that that technology is going from the edges of society to the core. And so basically consumers and businesses are using technology and software more and more. And those businesses and consumers' habits will change over the next 10 to 20 years. But clearly with the lockdowns and COVID, that's encouraged people to try and change their behavior, do things like we're doing today on a Zoom call. And it's, accelerated some of that demand and understanding. So flipping your question around, there are some stocks and sectors that benefit a lot from COVID, and has really set them up as we come out of COVID as well.
Yeah, that makes a lot of sense. Certainly, I think it's always interesting to relate your own experience, isn't it, to how that could be playing out in the broader sense, which is what you've just sort of referred to there. I mean, I know how much more time I've spent on Zoom than changes we've made in behaviour. So that makes a lot of sense that those businesses are well positioned. You also talked about briefly before, typically there's not a high turnover in your portfolio, and some years it's only one or two stocks. But this was the opportunity, this time last year, I suppose, and a little bit through the early stages of last year to make some of those changes. Have there been any positions that you've been trimmed or added to over the last quarter or, in the more recent times?
Yeah. So like on a day-to-day basis, we are repositioning around those core holdings, because basically what we're trying to do is not predict where share prices are going short term, but actually take advantage of what share prices. And if you take a further step back, it's really take advantage of non-fundamental moves in share prices. So we've got a pretty sophisticated process where we're monitoring the business quality score of each of our businesses that we own. We're monitoring their internal rate of return and valuation. We've got a bunch of risk adjustments, and that all feeds into setting our weights. But if nothing fundamentally is changing, so you're not changing any of your liquidity assumptions, your valuation, your business quality score, your risk adjustments, the only thing that's moving is the share price. And so if we're not changing any of those factors, for us, the share price is either going up or down for non-fundamental reasons. And then you can slightly adjust your weight. And so maybe all things being equal, if the share price is moving higher, you can sell that weight down. Maybe, you move it from an 8% position down to a 6%. And maybe another stock is actually drifting down because there's been no news flow. But again, nothing fundamentally has changed. So instead of being a 4% target weight, maybe you shift that to 6%. And so Domino's is probably a good example. And I mentioned Domino's because it's public and disclosed that we've recently sold a little bit down. But when if you go back a few years ago, when the Sydney Morning Herald released an article claiming that there was underpayments through the Domino's network and franchises, the share price did come off, and it probably came off from $65 to $40. And Domino's had been a really good experience for Hyperion and our investors because we identified it at $5 and it had compounded up, because it was growing at 20% per annum to that $65. But so we had to assess whether that narrative was real or not. And we believed it was a false narrative that, of course, you can have bad actors in any franchise system, but we didn't believe it was systemic. And we spoke to franchisees, looked at sort of 500 reviews through company Seek profiles. So you could actually go through and assess what people's experiences were like working in the stores. Like the data is out there, and there was some small underpayments, but it wasn't material. So we use that as an opportunity to increase our weight and buy Domino's aggressively. And as you wind through today, they've produced a couple of really strong results, and the stock price has moved from sort of $40 up towards $100. And it's not only the fact that Domino's has been investigated, they've disclosed the figures, and our thesis that it wasn't systemic has been validated, but they've taken that their pizza delivery model of low cost fast pizza out of Australia successfully into New Zealand, into the Netherlands, then into Japan, and now into Germany. And so they're starting to produce good, strong growth rates again, and the share price is rated to $100. But a lot of that's in our long-term valuation, and you can see that we publicly disclosed that we've reduced our target weight and reduced our share price. So there's stuff like that happening on a day-to-day basis around those core holdings.
Okay. What parts of the economy, so looking, we talked about at the start, we're talking about investing in 2021, so we should talk a little bit about, looking forward. What parts of the economy do you see has the most risk or potential, and what are some of your expectations for the current and upcoming reporting season?
Yeah, so we think of it with our business analyst hat on, so it's a bit different again to that sort of volatility and rotation. So we've seen over the last 2 to 3 days again a rotation away from the higher growth names into the more cyclical short-term value orientated names, and you have that from time to time. But we believe that is temporary because the world as we see it, and it really, once the GFC hit, the economic framework changed. We moved into a really low growth, competitive, disrupted world. And really that framework's existed since really 2008. And we don't see that changing over the next decade or so. So we think the main risk is, people getting caught up in these sort of short-term rotations, because what you're effectively doing is selling the future to buy the past. And so, which means, some of these quality growth companies, you're selling them down to chase some of these cyclical recovery stories, whether it's a mining or commodity business or a major bank. But that's with a short-term lens. Whereas when we look out long-term, we believe there's a lot of, again, fundamental risk in that those major banks are becoming less relevant, particularly to the next generation. And we don't think their earnings will be materially higher in 10 years' time than what they are now, and they could possibly be down. And then the major miners as well, they're commodity-driven businesses. There's nothing special about those businesses. So if you get seduced into, chasing short-term results because there's a short-term shortage, or property prices are moving higher as we come out of COVID, we believe that there's a real risk that you miss what's happening long term, and particularly in that framework that we've identified, because pre the GFC, for decades, that short-term value arbitrage worked well, but because it was really a high growth environment where you had a lot of tailwinds, you growing population, people could take on more debt, interest rates were coming down sort of for decades. It actually wasn't that competitive because, the smartphone was released in, 2008, and you can go through all the other innovations, which is moving software to the core of, again, society and businesses. So the world and framework is completely different now to what it was. And we think sometimes people sort of forget that. And because you had all that decades of data before the GFC, and people gravitate back into some of those old world businesses and chase short-term returns. But we think that's very dangerous. And really, we believe it should be an opportunity to go the other way and reposition into some of those, more modern businesses that will provide you growth. And will actually provide you some defense to disruption as well as we go forward.
Okay. Do you think there's any surprises that we would expect in current reporting season, or there's been some articles about companies and the impact of things like JobKeeper coming off and how that might sort of play out? That may be next reporting season potentially, but anything you think might happen or surprise us this time?
Yeah, so when we look through reporting season, which gives a snapshot of time, but some of the companies that we own as well, the resilience has even surprised us. So we've mentioned Cochlear through this call, and and REA as well, or realestate.com.au we mentioned through the call as well, and they're both companies that we've owned for a long period of time, and we did think that they're resilient and not that sensitive to economic conditions. But even the strength of those results have surprised us. So it doesn't matter whether you look globally or whether you look domestically here through the ASX, those really good businesses have really stood up. And the reason why it's so interesting is because you've had a result to the 6 months to the 31st of December 2020 that was impacted by COVID, and comparing it to results that were pre-COVID. And for some of these businesses to hold the line and have flat results is really outstanding. And that's what I mentioned earlier, not to get too caught up in these short-term rotations, because what's actually happening in the results, it's actually validating some of those companies, how special and how strong they are. And if you get caught up into some sort of rotation which is not fundamental, you need to sort of remind yourself and go back and have a look at the accounts and see what's happening. But certainly some of those businesses, again, in the healthcare space and the technology space, have produced really strong results. So reporting season has actually been surprisingly strong for some of these businesses.
Fantastic. So for everybody playing along at home, we've got about 8 minutes to go. So if you've got any questions for Jason, I've got a few more here I can use, but if anyone's got any questions from home, please type them in using the Q&A tab down the bottom, and we've got some time to fit those in. You mentioned about the change in the environment and from high interest rates and reducing interest rate environment, and now we've got record low interest rates. Have you or your team got any views on interest rates, global debt levels, the Australian dollar, those types of, I guess, macro issues, and how they might affect your portfolio or companies in general?
Yeah, so like if you start with the Australian dollar, we think it'll broadly hold these levels and sort of being range bound. And our analysis and modelling over time suggests that the strength of commodity prices does have an flow-on impact onto where the Australian dollar goes. So it's obviously being supported by that at the moment. But our modelling long-term modelling suggests that in the 70s is probably something a natural place for the Australian dollar to be versus US dollar. But I think the more interesting question is to your point around what happens to interest rates and inflation. And there's potential for interest rates to rise slightly at times, but we believe fundamentally we're in a low inflation, low interest rate world. And it does come back to the fragility of businesses and society. Interest rates need to be low to support those debt levels and support the economy. And you've seen that with inflation. And again, you might get short-term upticks, but there's so many structural reasons or macro headwinds. So at the end of the day, those macro drivers will dictate where things are going. And basically, wages are under pressure, energy prices are under pressure, and they're all being disrupted by new models. And so human capital is obviously being disrupted by technology again. And so the bargaining power of humans continues to lower. And you see that with the Fed, you see that with the RBA, where they're actually prepared to put up with asset inflation because they don't believe that underlying inflation's there, and they understand how fragile the world is. And we've had a glimpse into that through Japan. And so what's happened in Japan for decades, where they've really had no growth and they've had to try and support it. And actually it does show with their debt levels that developed countries can support high debt levels. And so I think what people will end up accepting is these high debt levels and continuous stimulus will go for potentially a long period of time. And we believe interest rates and inflation are going to stay low for a long period of time, which is supportive of asset prices though.
Okay, that's great. Thank you. We've actually got a couple of questions come through from home, which is great. So thank you. So one of them is about from Maria. Hi, Maria. About Afterpay. So Maria's comment is Afterpay is obviously a successful business, but in her circumstances, she wouldn't use it to buy anything because she doesn't need to. She's also concerned about, there's been lots of stories about encouraging bad buyer behaviour and people to buy stuff they can't afford. To what extent does Hyperion consider those types of factors, or the social impacts, or maybe even more broadly the ESG impacts of the businesses that they're investing in?
Yeah, no, it's a good point. And Afterpay is a good example because all these the next winners always climb a wall of worry, and people don't understand the business models. They don't understand the value propositions, and it requires time for the market to become comfortable. And as they grow into, the next blue chips, people, get comfort with that. But you're right, like each ASX ticker is a business, which is a product. And so you clearly need to understand the value proposition of that product. And for us, the next generation doesn't really use credit cards. And when you go and look in the US, if you're under 30, you probably don't have a credit card or have a traditional relationship with a major bank. So their relationships and behaviors are completely different for how I, grew up and with the use of a credit card. And in a way, we think there's a lot of positives to the buy now, pay later, because you don't get into those predatory interest cycle traps where your balance grows, you're getting charged 15, 20% interest. All of that goes. So we do think it's a modern product for the modern times. And as the millennials and Gen Zs become, more powerful and take up a larger proportion of GDP, they will drive that behavior. But ESG goes within that value proposition, and that's core to what we do, because if we're going to own these businesses for 10 to 20 years, they have to be sustainable. You can't take shortcuts. You can't externalize costs, because eventually someone will make you internalize them, which means you'll be accountable to society, you'll be accountable to the government, you'll be accountable to regulators. And so we spent a lot of time thinking whether Afterpay would be regulated and whether they're a net benefit to society or not. And our view was that they are a net benefit. It is a product that shouldn't get regulated by the normal credit rules because they don't charge interest. So we actually think it's a far superior product to credit cards, although the next generation will have to drive that usage more to the mainstream. But absolutely, if we thought there was ESG issues, we would sell, because it does come back to that protect and grow again. Like, we do not want to get a permanent loss of capital, particularly from some ESG issue.
Great, thanks for that. Got one more question that's come through, and it's probably all we've got time for, because we're almost out. Question about what are the thoughts on the decisions of some of the businesses to take larger holdings in cryptocurrencies? And do you feel that that's an area that you should be exploring, and is that in shareholders' interests?
Yeah, so really a hedge to that inflation that we talked about, and for those structural reasons, we think inflation's unlikely. But you could get stagflation, which means you have low growth, but government's doing crazy things like throwing money out of a helicopter effectively, which means that you do get this stagflation, and that's where traditional assets like gold comes in, and then you would argue things like cryptocurrency. So they're effectively gold 2.0. There's limited supply. We know that, and so there is value and utility in things like Bitcoin, which are clearly dominant players in cryptocurrency. So we're not really surprised to see some of these companies offshore. Like Square was the first to do that, sort of around October last year. They bought more as well after that. They've just disclosed that 5% of their assets are in it, and then we've seen Tesla come out and put 8% of its cash in there. So we don't think it's actually a ridiculous idea, because even someone like Tesla, which has got 20 billion of cash on its balance sheet, it traditionally would put that in US dollars or euros or treasury bills, and putting some of that in gold is quite difficult. So they're putting a proportion of that asset into effectively Bitcoin. And so we think we'll see more and more of that as people understand the value proposition of cryptocurrency and leaders such as Bitcoin. We haven't seen that in Australia yet, but it definitely started offshore, and we expect it will come here. And really, it's actually started to become investment grade. And as those corporates accept it, PayPal, for example, are going to allow you to transact and store PayPal, so is Visa, so is MasterCard. So it is coming. We don't, it's not our day job to, invest in, Bitcoin or cryptocurrency, but we understand it. We're watching it carefully, and it is a modern product as well. So.
Yeah, I thought from your talk about modern companies, that would be right up your alley. So I'm sure you're across that, which is you've just shown there, which is great. Well, unfortunately, we are out of time, so we've come up to 1:15, which is when we said we'd be finishing. So we'll wrap it up there. But thank you very much, Jason, for your candor and your excellent insights today. I certainly feel like we got a lot out of it, and I already knew that our investments were in good hands with Hyperion, but hopefully that'll help spread the word for our clients and other people listening at home. So thank you very much for your time today, and thank you to you and your team for all the great work you're doing for us.
No, thanks, Jeff, and hopefully that was useful to all those that dialed in. Thanks, Jeff.
Okay. And for everybody playing along at home, thank you very much for tuning in. Thanks for the questions that came through now and beforehand as well. Hopefully you learnt plenty from Jason today. Please look out for our upcoming webinars, and don't hesitate to contact us after this with any questions or feedback. But in the meantime, have a great day, and we'll sign off. Thanks a lot.
Thank you. Bye.